So the first question that we're going to go through and answer is ensure there that looking at the board and whether or not they are effective. Now, the way in which the board can be seen to be effective is if they go through and follow the rules there of the combined code. Now there, what we need to have there is a board of directors. And the key bit there about your board of directors is that they there are responsible for the company's success. So going through there and ensuring that they maximise the shareholders' wealth. So what you need to have there is that those boards, your directors, need to meet regularly. Again, there's no specific definition on how regular that may be. It could be monthly, quarterly, 6 monthly, annually. It depends upon what is suitable for that given business. What they also need to go through and do is also present what we refer to as a balanced and understandable assessment of the company. So if you like, they're responsible for going through and preparing your financial statements, showing how this company has performed, showing what the company financial position is at the end of the year. Now, how do we go through and ensure that we have a balanced assessment? How do we ensure that when they meet regularly that there are no individuals dominating the board? Well, what we have there, and I'm sure you all remember, is that your chairman and your chief executive officer, they have there your separate roles. Yeah, so it's there, the chief executive officer, to be there for the day-to-day operations. The chairperson is there, if you like, to visit the company on a regular basis and to go through there and see that the principles of good corporate governance are being followed. What we then have to have there with your execs and your non-executive directors is that there you really need to go through and strike a good balance between non-executive and executive directors so that no individual director dominates the group. Now again, key thing there is that when you're going through and looking at your executive directors, they are there more for the long term, the longer duration, and they look at running or managing the business more than what we have there with respect to your non-executive directors. They are just there more for the short term. They will be visiting the business on a less regular basis. You know, in some businesses it could be once or maybe just twice a year. And the non-executive directors are there to go through and offer their advice from based upon what they've had with past experience and to ensure that the good corporate governance principles are being followed. Other bits that we can go through and think about there is also going through and thinking about how the board is, one, remunerated. So you'll need to think about your remuneration and also start thinking there about the appointment of your directors. Now, with respect there to your remuneration, the amount that your directors should be paid is amounts there that are sufficient to go through and attract the quality of the directors that you need within your business. Again, it doesn't set a value, but it's something that you need to consider. You may then have to pay more to get better quality directors to make the decisions within your business. With respect to the appointment of your directors, that should go through and follow a formal and rigorous process so that we go through there and that the shareholders will get the directors that they so wish. If they wish to remove a director, that is well within their rights. But once they have removed the director, they should then have a say in who is then appointed. With respect to our second aspect that we're going to look at in corporate governance, we need to look there and see whether or not the directors are making appropriate decisions. You know, we've got there a well-balanced board, mixed of execs and non-execs. We've got the separate roles of chairperson and CEO. We have a clear, transparent procedure to go through and appoint or reappoint your directors. And we know there what we should be paying them with respect to their levels of remuneration. However, what rules, what, if you like, guidelines are we given in terms of what the directors should follow to establish good principles of corporate governance? Well, what we've got there are your Cadbury reports. We then can go through and start to look at your Greenbury Code. And what you've got there is that the Cadbury Code and the Greenbury Code, well, they were then not subseded or superseded, but what we then had was the Hampel report, which then just went through and just ensured that the good corporate governance principles laid down within the Greenbury and the Cadbury reports were being followed. What we've also got there is starting to look there at the Turnbull report, and then we'll start talking about your Higgs and your Smith report. Again, you've got some detailed notes about those various reports within the exam. The examiner doesn't want to go through and test you in huge amounts of detail on your knowledge of them, but you should have an idea of what each one of those reports or codes is doing. So let's just go through and summarise the basics. Now, the key things that you need to go through and think about with respect to these various reports are, first of all, if we go through and look at the Cadbury report, again, as we said, the detail is contained there within your notes, but the key bit that you've got there about the Cadbury report is that it set out the foundations. It was there published in 1992, and it went through there and set out the recommendations for the arrangement of your company's board and what accounting standards that the board should be adopting for that given company. The reasons why it was introduced in the first place is that it was just to go through and ensure that there was a little bit more confidence in your listed companies and the governance that was taking place. Because there were difficulties within the late 80s and early 90s with various corporate scandals that took place. And it was felt that the various boards of directors were not implementing enough level of controls. They weren't following true accounting standards. The balance of the board was incorrect in terms of making good decisions. So what we have there is the Cadbury report. What then followed with your Cadbury report was then going through and looking at your Greenbury Code. Now, your Greenbury Code there, or your Greenbury report, that went through there and set out the principles behind the determination of your directors' pay. So it offered a little bit of advice as to how directors should be remunerated. And as a director's remuneration can be quite large with respect to the profits that a company makes, it needed to be then a little bit more transparent about how directors were getting remunerated. So the Greenbury report went through there and emphasised that there should be disclosure in your annual company financial statements about how much directors have been paid and how that pay is remunerated. Is it there as a cash salary? Is it a bonus? Is it share options? Is it there as some form of pension? In terms of going through and looking at the third item as to whether directors are making good decisions, the Hampel report was there, which was produced, as we said earlier, to combine the Cadbury and the Greenbury recommendations, and more importantly than anything else, ensuring that they were being followed. What we then have is the fourth aspect to go through and consider to ensure that directors are making good decisions is there your Turnbull report. That there is specifically aimed at listed companies on the stock exchange, and it goes through and informs the directors of their responsibilities under the combined code. So again, just emphasising things that have been seen before. But more importantly, what the Turnbull report did was focus very much so there on your internal controls. Because if a company has a good system of internal controls in place, then that should go through there and prevent any issues or problems in the future. If you think about BP, if BP may have had some better internal controls, then maybe that could have gone through and looked at more risk management and then prevented there being the disaster there within the Gulf of Mexico. Again, there are similar examples that you can go through and look at in terms of the internet. Use the internet to go through and look at difficulties, issues, problems that companies have had. If they think they're about risk management, if they incorporate internal controls, then maybe that damage would have been limited and there would have been less of an impact there, not only on the company but also the stakeholders. If you think about the oil spill in the Gulf of Mexico with BP, there was a big impact on the share price, but also as well there was a huge impact on the local stakeholders. The local economy suffered as a result. What you've then got there in terms of the fifth aspect to go through and look at is there as the Higgs report. Again, what the Higgs report went through and did is that reviewed the role and the effectiveness of our non-executive directors. Again, that followed there further corporate scandals that we had in the early parts of the millennium, so things such as Enron and WorldCom. So what it did there is it ensured that where the combined code had some areas of discretion attached, that these were removed. So very much so going through there and giving more detailed rules on what we already had in place. What you've got there, last but by no means least, is going through there and look at the SUMIF report. That very much followed on from the collapse of Arthur Andersen and the scandal that it became involved in with Enron. The key bit there is that the SUMIF report focused on the independence there of your internal auditors. Because again, if you've got a good system of internal controls, if your auditors are monitoring the internal controls, if they are monitoring the independence of your non-executive directors, then these corporate scandals should hopefully no longer happen. And there will be a better relationship between what happens with the shareholders and the directors. The last bit that we can go through and look at there is we've gone through and looked at, are the board effective? Are they making good decisions? But now we as shareholders need to ensure that they are. Okay, so what we need there are assurances that the board are making these good decisions and we have an effective board in place. So what we have there are disclosures that you can put there within your financial statements. So there, what you've got are disclosures based upon your FSA listing rulings, and then there your FSA disclosures and your transparency rules that we need to follow, as well as going through there and looking at the disclosure that is required there by the combined code. The disclosures that we need to make there with respect to the FSA listings are how a company has applied the code. How has that combined code been applied? And also that if we have gone through and applied the code, then it needs to be there disclosed whether that has been done for all of the accounting period. If you haven't gone through and used the code for the full accounting period, you should go through there and disclose that to the users of the accounts so that they then have a better understanding as to when those good principles of corporate governance have been applied. With respect there to your FSA disclosure and your transparency rules, that very much focuses there upon the audit committee. Now there, when we're looking there at the audit committee, what the rules there say that we should disclose is who carries out the role and how they go through and carry it out on a day-to-day basis. It's very important here that the directors go through and communicate to their shareholders that they give details of their internal control and risk management. Because at the end of the day, that is what your audit committee is going through and doing. It is ensuring that there is a good system of internal control and that any risks that can be faced by the business are managed so that those risks are prevented. In terms of your combined code, that goes through there and looks first of all at how your board operates. So how many meetings have they had during the year and who is there as a member of the board. Other aspects there is that you need to look at the names of your directors and disclose them along with their remuneration. And we also need to look there at the number of meetings that they have had. Clearly, the more meetings, the better. But what you just need to have within your exam, in terms of your knowledge, is just a brief idea of how, as a company director, in your role, you can go through there and communicate to the shareholders that you are applying the rules of your corporate governance and how you are applying them. That's all you will need within your exam. Read through the detailed information that you've got within your class notes and that you have there within the LSBF study manual, and then what will happen is you will then start to pick up more and more of a detailed knowledge, and it will make answering the questions on corporate governance that bit easier.